The S&P 500 has provided year-to-date returns of 26.7%, but major investment banks all around the world think 2022 might not be such a profitable year for investors. There has been widespread speculation that 2022 could be the year of a dot-com bubble-sized crash, which could see the value of the stock market depleted in spectacular fashion, just like we saw back in the early 2000s. Some of the rationale behind this being expensive and overpriced stocks, persistent high levels of inflation triggering higher interest rates, resulting in growth stocks crashing, and high growth companies with no earnings will be hit the hardest with drawdowns of 30% or more. On the basis of this thesis, high inflation, high valuations, and a hell of a lot of greed in the market could be investors' biggest downfall during 2022. But what are investment banks saying about the future prospects of the stock market over the course of the next 12 months? And how do we as investors position our investment portfolios the best in order to maximize our return on investment? Well, let's talk about it, guys, but before I do so, my name's Mitch. I post all kinds of videos on investing and the stock market. If you do enjoy content like that, hit that big red subscribe button down below, as well drop a like on the video, guys. It really helps out the channel. With that being said, let's dive straight into it. So as of right now, there is a little bit of a mixture of opinion between media outlets as well as investment banks on the future outlook of the stock market in 2022. Media outlets are obviously doing the best job as they possibly can to spread as much fear as humanly possible, whereas investment banks, on the other hand, are being a little bit more objective. And that's probably one of the things to call out at the very start of this video when you're doing your research on the stock market itself and just the general outlook for 2022, when you're looking at kind of the media and news outlets where they do a fantastic job of absolutely scaring the shit out of people. So because of that, you should only really take what they say with an absolute pinch of salt. Whereas investment banks, on the other hand, have multi-billionaire clients on their books. So because of that, they're going to have a little bit more informed, data-driven decisions, which help billionaires and multi-millionaires inform their investment decisions. So with that in mind, we're going to take a look at two different reports, one from UBS as well as Goldman Sachs, who over the course of the past couple of days have provided their outlook over the course of the next 12 months. So first up, let's take a look at some of the analysis and thoughts of Goldman Sachs. So first up, they provide some commentary around decelerating economic growth, a tightening Fed, and rising real yields, suggesting investors should expect modestly below average returns next year. And if you caught my video on inflation, which I posted yesterday, then we've already touched on some of these topics. I think for me personally, the biggest issue right now that many investors will face, especially if you've been a new investor over the course of the past 12 to 24 months, is that you might have a little bit of a false sense of reality when it comes to stock market returns. To provide some context, since the March lows of 2020, the S&P 500 has grown 103%, the FTSE 100 is up 40%, and the Nikkei is up 79%. Literally every major world indice across Europe, America, and Asia has literally been on a tear over the course of the past couple of years. And I think it's probably quite likely, especially if you're a newer investor in the space, that you probably think these are the kind of normal investment returns in which you're probably going to expect within your investment portfolio every single year, whereas the reality is actually quite different. Average returns of the S&P 500 are roughly about 9% per year, which is certainly a far cry away from the near 30% return on investment in which we've achieved during 2021. And I think after seeing such a huge run up in stock prices, along with high levels of inflation too, it comes as really no surprise that Goldman Sachs have certainly took a little bit more of a, I guess you could say, a little bit more of a cautious view of the stock market into 2022. To give you guys the exact numbers in which Goldman Sachs have actually put out for a forecast for the S&P 500, well, by the end of 2022, they're expecting the S&P 500 to trade at 5,100 points, which is about an 8.5% uplift based on today's valuation of 4,700. This does certainly align a hell of a lot more to historical market averages, as opposed to the kind of stock market returns in which we've seen over the course of the past couple of years. And certainly don't get me wrong, guys, because an 8.5% return on investment every single year really isn't a bad return on investment. If I could do a consistent 8.5% return on my current investment portfolio over the course of the next 30 years with regular monthly additions into that portfolio and let the power of compounding to take place, well, over the course of that duration, my investment portfolio, the pot would be valued at near on 2.3 million quid. So certainly don't get put off by an 8.5% growth rate because it's still a solid return on investment. So with that said, now let's take a look at what UBS had to say about their future market outlook, because they also provided a little bit more guidance on what you should actually be looking to invest in 2022 and beyond. So UBS Chief Investment Officer has commented stating that they expect inflation to start to fall in the second quarter of 2022. Our base case is for inflation to normalize, but there is certainly uncertainty. Market sentiment could overreact to incoming data, but we don't anticipate the Fed hiking rates until 2023. So that's certainly a little bit more of an interesting turn of events. They expect, based on this commentary anyway, for inflation to be a little bit more transitory and expect that it will start to fade away by the middle or at least towards the end of the year. To align to that, the Chief Investment Officer goes on to say that economic growth will likely remain above trend for the first half of 2022, benefiting cyclicals including Eurozone and Japanese equities, US mid-caps, global financials, commodities, and energy stocks. It's interesting to see here how there's simply no mention of US large cap or mega cap stocks, which is probably something that you're going to want to consider if you've primarily got an investment portfolio actually a little bit like mine, which is made up heavily of big tech stocks over in the United States. But the Chief Investment Officer then goes on to say, although growth is set to be strong in early 2022, favouring cyclical sectors, a slowdown over the course of the year should start to favour more defensive parts of the market, such as healthcare. So it's certainly an interesting sentiment. With forecasted growth rates throughout the course of the first half of 2022, well, your kind of bigger tech stocks could be very much the advantageous play to make during the first half of the year. But during the second half of 2022, as a slowdown starts to take place, potentially even interest rate hikes, this could be a good opportunity to place your investments into perhaps more conservative parts of the economy, or even perhaps invest into some recession-proof stocks in order to protect your investment portfolio against what could potentially be some adverse market conditions. So I guess logically and objectively speaking, when we're thinking about this from more of a macro view about the kind of stocks in which we're going to want to invest into, obviously, right now we have high levels of inflation, which is obviously very, very bad for growth stocks, but certainly good for stocks in the consumer staples sector. The potential of interest rates being hiked towards the back end of 2022 and perhaps into 2023, which is certainly good for financials. Then generally, overall slowing growth towards the back end of 2022 is certainly going to be bad again for growth stocks, especially those in which are unprofitable, meaning you potentially want to position your investment portfolio into perhaps more defensive stocks that are pretty much a little bit more cash heavy, along with possibly even paying a dividend too, which, as UBS said, healthcare could be a very good option. They're certainly the first three sectors that spring to mind when I'm thinking about repositioning parts of my investment portfolio into 2022. Now, due to this sentiment, UBS have a current forecasted target for the S&P 500 of 5,000 points by the end of 2022, which is an uplift of just 6.4% from today's current prices. So UBS certainly have a slightly less bullish outlook than what Goldman Sachs have. But what I find most interesting about UBS's outlook is they actually go beyond that of 2022 and they start talking about potential opportunities, investment opportunities over the course of the next 4 or 5 years into 2025 and beyond. The Chief Investment Officer stated, over the longer term, we see opportunities in disruptive technologies, the net zero carbon transition, and empower alternatives to unlock return and manage volatility. To provide some more context, they follow this up by saying the combined revenues of ABC technologies, which are artificial intelligence, big data, and cybersecurity, are expected to grow from $384 billion in 2020 to $620 billion in 2025. Capturing growth in these areas will require investors to look beyond just mega cap tech stocks and focus on mid cap names that could just be the next big thing. These three areas are certainly industries in which I'm personally interested in and also agree that they have great amount of potential over the course of the next decade to come. The writing is pretty much written on the wall for these three areas. We already know that big money is flowing into these areas, with businesses as well as governments spending a fortune on things like cybersecurity, big data analytics, as well as artificial intelligence too. It's why I'm bullish on stocks like Palantir Technologies, but just generally speaking, I certainly do feel like I do need to do some more research into this area in order to potentially add a couple of more stocks into my investment portfolio that cover off these different areas. So if you've got any suggestions, guys, be sure to let me know down in the comment section below. The Chief Investment Officer then follows these statements up by saying the net zero carbon transition looks set to prove to be one of the most consequential investment trends over the course of the next decade. Attaining net zero is expected to require global investment in renewables of $50 trillion for each decade until 2050, with 50% of emission reductions needing to come from underdeveloped technologies. This creates opportunity across green tech, clean air, and carbon reduction solutions and carbon trading strategies. It's another huge area and certainly something on the global agenda that's going to have a hell of a lot of investment money going into this area over the course of the next coming decades ahead. And many businesses already out there right now are already committing to kind of be net zero by 2030. So that's going to mean a hell of a lot of investment just over the course of the next 9 years. And with governments making that same commitment, largely speaking, by 2050, well, it means that there's going to be multiple decades worth of high levels of investment going into the kind of green energy space, and therefore a hell of a lot of potential investment opportunities to go along with that too. So in summary, both investment banks are overall bullish for the stock market during 2022. There is certainly no talk whatsoever in any of the reports in which I've read of a potential market crash of 40 or 50% like we saw during the dot-com bubble, which burst back in the early 2000s. And whilst obviously you can never say never that a stock market crash may just occur, nobody truly knows, I think what we will inevitably see is further inflation into the start of 2022, potential rate hikes and slower growth in the back end of 2022 into 2023, at which point things will start to stabilize and investment performance will potentially look to be more on the upside after that point in time. But that's just my own personal opinion, guys. Be sure to let me know yours down in the comment section below, and if you did enjoy this video, guys, be sure to drop a like on it, subscribe to the channel if you're new around here, and with that being said, I'll see you over in the next video.